Welcome back to another episode of Key Factors Podcast. I'm your host, Mark Jones, and we are powered by ReviewMyMortgage.com, the largest index of mortgage programs in the nation. And never has that website actually been more valid for an episode like today's. We're actually going to be discussing the ins and outs, the 411, the low down on the down low, and I'm talking down payment assistance. So I've brought along two guests that have an extensive experience in dealing with consumers, down payment assistance, housing programs, and things of that nature. So before I introduce my guests, I want to ask you, the listener, do you know, and I'll also ask our guests at the same time, do you know what DPA stands for? Raise your hand. Just raise your hand. Okay, just making sure. So let's move on to our guests. First, I've got Yvonne Godina, Senior Loan Officer with I Think Mortgage. How you doing?
I'm doing good. But y'all guys, I'm rebranding myself. So I go by YG.
YG
nowadays.
in the house.
I
love it.
Not like the rapper, but just YG doing loans.
You know, when you told me that, I'm like, I'm not up to date because I don't even know there's a rapper named YG.
Yeah, don't get the content
twisted.
Don't get the content twisted because you may not want to do business with me after you listen to some of those songs.
Absolutely. And my second guest today, who is somebody that I respect very, very highly in our industry and what he does for us other mortgage loan officers, that's John Hudson, Vice President of Mortgage Financial Services. How you doing, brother?
Man, it's great to be back.
It is always great
Yes,
to
sir.
have you on here. I think every time that you and I come together, there's a lot of great information that comes out. And a lot of times I don't know, but I know the right questions to ask. And that kind of leads the road.
They just kind of come out.
Yeah. You call them hot takes on sports bets. Yeah.
Hot sports opinions.
There you go. So guys, if you can, tell our listeners who you are, how you got in the business, or when you started and where you're at, all that good stuff in a brief moment, because a lot of the listeners don't know who you are. And some do, but this is a great chance or opportunity for you to elaborate on that.
Yeah. So I'm Yvonne Godina, known as YG. I've actually been in the business for almost 3 decades, 27, awesome. 28 years.
Okay.
Yeah. So John and I were actually talking for a little bit. The down payment assistance that's today was way different back when we started, guys. So we've been around the block. But I'm pretty passionate about helping families create wealth and get into homes. I'm also kind of going through a rebranding part. You know, you've been in the business for some time. You hit some peaks of where you just not helping as many families as you are. And so this year has been an amazing year and starting off really good. So I'm excited to do that. I'm also a single mom, and I've got 4 kids, 2 girls at home, teenagers. So you know how expensive that can be, guys. And then even young adults, they don't want to leave you anymore, you know, and it's because they probably need these down payment assistance programs so they can go buy a house and get out. But yeah, so I'm just really passionate about it and been doing it for a long time. So I'm really excited to be here with you too.
Absolutely.
Learn a lot. And so here to help.
Hey, can I give you some life advice that I hope that I can take when the turn's tabled?
Say no.
Kick them out.
Kick them out.
Kick them out. That's what my parents did. Yeah, they're just boom, give them the boot. No. I'm here to help. Anywho, so John, tell us about yourself.
Yeah, no. Executive Vice President, Mortgage Financial Services. I run our wholesale and
Mm-hmm.
help with our retail divisions as well. But I will say that I'm a self-certified mortgage geek.
Boom.
I've been doing this for 26 years. Yeah. And I guess kind of along the same lines with those passions that you described. When I got in the business, I was just a junior in college.
Sure.
I barely knew I really didn't know there was a T in mortgage. And
wait, there's a T in mortgage?
Yeah, apparently so. Apparently so. And so one day I was trying to figure out how am I going to pay for beer during, summertime.
Sure.
And saw a posting for an internship with North American Mortgage Company. Had no idea what I was getting myself into, and went out, interviewed, got the job, and went there. I was basically a loan officer assistant. No idea what I was doing. Started calling people, asking them if they fixed their credit up, et cetera, et cetera. And did that for a little bit until finally one day I went to my first closing.
Okay.
And the loan officer I worked for took me to a closing, and I'll never forget it. It kind of gives me goosebumps thinking about it. I could close my eyes, picture this woman's, her curly blonde hair. She was wearing blue nursing scrubs. And at closing, this woman started crying. And she started crying because she was a single mom and finally gave her kids a backyard to play in.
How freaking cool is that?
And call it a sign from the heavens above. I mean, my mom happened to be a nurse, and we were, she was single when she was raising us, so it was like a little something grabbed me at the strings there. But I started to go, wow, there's something really to this home ownership thing,
right?
And so on the way home, stopped by the bookstore, bought Home Buying for Dummies and How the Bond Market Works.
There you go.
And I've literally been a student of the business since then.
Now, John, let me ask you, at that time, your first closing, being in the business, were you a homeowner or were you still renting at the time?
I was renting.
Okay. Yeah, no. And most loan officers, when they start in the industry, are renting still.
Yeah.
Because they're starting a new career, many different reasons, but I'm just wondering.
Yeah. I was still in college and graduated in 1999.
Mm-hmm.
And, still living the, 21-year-old single lifestyle.
Yeah, absolutely.
And bought my first house, though, in 2001.
Okay.
21 years old.
Well, there you go.
Put zero down, by the way.
Same. I did USDA, no money down.
Yeah.
Best thing I ever
100%
did.
100% financing. Mm-hmm. So you don't need a down payment, which kind of was where we're going
That's
here.
Where we're at. That's where we're at.
Well, I went the opposite. I did an owner finance.
Okay.
Boy.
And I think right when I started the business, I was at USAA. So let me tell you, at that point, these were like the cream of the crop. There was no credit issue. There was no...
Super conservative.
Yeah.
Super conservative. You either had a loan or you didn't, and it was literally black and white. There was no gray like we look at things now, right?
Sure.
But it was black and white at that point.
Mm-hmm.
Wow. Probably 20% down for...
20% down. And let me tell you, our title was loan officer, but we were not loan officers.
No.
We didn't take an application. We didn't know what a 1003 was or how to complete it. If you were interested in a loan, we said, let me transfer you over to PHH Mortgage.
Yeah.
And they did the loans initially.
Now, YG, those still exist. Yeah. They just happen to work for banks and credit unions, just so you know.
They do. So eventually USA switched where they realized, I guess, we can make some money off of it. And then they started originating. So we did get some expertise on that. And then I went to the builder world. I was telling John, I went to work at KB Homes. And let me tell you, from going to cream of the crop, 800 credit
to throw it against the wall and see if it sticks.
To I helped, family members closing on a 497 FICO score. I mean, I was like, whoa, what is going on here?
Totally different world. Yeah.
Totally different.
So as we jump into our first topic, I want to make sure that the audience is aware that this is going to be very informative. We may have different debates on opinions and how things are perceived, but the guidelines, the principal basis of down payment assistance are clear to the guidelines. Each of the actual bonds or grants or government agencies have their own set of guidelines, and some of them may follow the normal Fannie Freddie guides, but they may have nuances. So we're here today to talk about all of that stuff from the basics and beyond. So our first question or first topic is, what does DPA stand for? And I think the obvious is down payment assistance. There is nothing else to it.
Oh, but where's the little ... And closing cost assistance.
That's very true. So, I wonder why they don't add to that, because the DPA is, how do I say it? I don't want to say misleading, but it's almost short of what it could actually be.
Sure. I think because we're lazy and we like acronyms in our industry. I mean, what would that be? DPA, CCA?
Yeah.
There you go. And then don't forget the CYA.
Right. And C.
But I think there's a misconception of down payment assistance, and the keyword being assistance, right? Where I think there's a lot of people, the public, think that it's free.
Right.
And it's not. It's assistance.
Well, let's get into that. So within the realm of down payment assistance type programs, it's important to know who offers these programs. Where do they come from? And I think the root is you're looking at either grant or bond funds that are distributed through government agencies. And I listed quite a few, but essentially it's San Antonio Housing Authority, acronym SAHA or TDHCA, Texas Housing
Texas Department
of Housing and Community Affairs. And they go on and on. Seth, same thing. But I think a lot of folks believe that they are down payment assistance when they're in fact government agencies that help facilitate the down payment assistance. There's also an investor behind that and an originator also tied to it. Most mortgage companies offer these types of programs. Now, John, I'd like to pick your brain on the process of why some mortgage companies don't offer them. Matter of fact, let's table that and keep going down the basics road, because with the idea of down payment assistance, like YG said, it's not free money. You're either getting it by way of a grant or you're getting it by way of a bond. And knowing the difference between the two, I think, is important for people to know. The grant funds itself don't have to be paid back, whereas the bond funds, they do have to be paid back in some cases.
Right.
In some cases, right. Because you do have programs, which we'll get into later on how to read a pricing sheet from these down payment assistance, but there are different options within those type programs offered by different government agencies. Did I kind of nail that?
I think you did, and I believe that it also kind of starts too with in the home buying journey of working with a mortgage professional that knows of these different options that are out there, and not every borrower is even aware of how much money that they need to bring into closing.
Correct.
Whether it's down payment or closing cost or a mixture of both, and so. From there, you take the borrower's profile and you really just kind of funnel it through a matrix and see which programs can they actually qualify for. And then that loan originator should go through and figure out, okay, which program is best for this customer. Right. And then present them with door number 1, door number 2, door number 3. Mm-hmm. There's a lot of folks out there that perhaps even just assume that they need down payment assistance.
Right.
When in fact they don't.
Right.
And if they don't, then perhaps they can get a better mortgage term for themselves.
Absolutely.
And so it kind of goes back to that very first beginning of the mortgage journey for a consumer, and that is working with a mortgage professional that knows of all the options that are out there available.
Absolutely. No, you are exactly correct. And consumers these days want to know what their options are before actually speaking to one of us, which is why I'm going to toot my horn for just a moment. This is essentially, guys, you hear me often referring to Review My Mortgage, which is the sponsor of this show, but also the largest index of programs. And when we say largest index, we're talking bond loans, grant loans, MCC participants, things of that nature, based on the county. You can plug in exactly where you're trying to purchase, your credit score, how much you have or how much you don't have to put down, and it will literally tell you exactly what bond programs, grant programs are available in your area at that time. So I toot my horn because that's what the future holds. I mean, you've got lenders all over the place that truly don't know all the nuances that we're going to go over today, but will speak it into existence, and then the crowd starts to believe it when it's not the actual, or there are many nuances to this type situation.
And it gets into, I think there's a Facebook post that I really, really wanted to chime in, but I'm trying to hold back on certain things. But I think of some of your posts that I love, which are always your "prove me wrong" post, right? And there were some allusions to down payment assistance not being great, and it's like whoa. First of all, every consumer out there has a different journey from each other.
Correct.
I mean, I've literally seen tens of thousands of loan scenarios in my career, and they're like snowflakes. No two are alike.
That's right.
Right.
And what's good for one family may not be what the other one gets. So I hate when I see things getting painted with a broad brush.
Correct.
And then also in today's environment, it's a rough economy out there.
Absolutely.
And people are scared about going into the future, and maybe they have money saved up for a down payment, but they're nervous about losing it.
Yeah.
Right.
But I think you hit on so many things where we're giving them option, and that's really what a good loan officer is.
Yes.
Is that if I'm giving you options, I'm not making a decision for you, or I'm not trying to put you into a loan that maybe our bank is going to make more money on. I'm trying to find out what's important for you and your family.
Right.
And if I can give you those options so that you and your family can make a decision, then I've done my job.
Absolutely.
Right.
Door
Agree.
number 1, door number 2, door number 3, choose your own adventure.
Correct. And I think that I guess the concept of having all of the options available, we as loan officers should know how to properly educate the consumer on those things.
The consumer and our realtor referral partners.
Oh, absolutely. Absolutely. I agree with that. Because you do see quite a bit of realtors marketing or using those as marketing tactics when they don't know the full gamut of it. I have no issues with it as long as they do it the right way. But if you're expecting to use that to gain business, just know what type of business you're going to gain by doing that.
Right.
You know, that's not a problem. Make sure that your lender knows what the heck they're doing when it starts, when the spigot turns on. So
Or
to
that
speak.
your lender's even on these websites, because sometimes they'll advertise, right?
Yeah.
And they're talking about down payment, and they're not even listed on some of these agencies' websites that they're eligible, or their companies
That's
eligible
true.
to do these loans.
That's true. So I guess we can get into that. I mean,
Yeah.
what does it take for a lender to participate in these type programs? Because I know when we made the transition from Directions over to I Think, which is a DBA under Man Mortgage, we were 2 weeks in and already ready to go with our down payment assistance, with our text vet loan participation, with Gateway. I mean, it was pretty quick. I don't know what happened behind the scenes. I'm sure you do, though.
Yeah. So from a lending standpoint, right? And there's just for everybody out there, there's 2 channels for which a consumer can get a mortgage, either through the mortgage broker channel or through the retail channel.
Correct.
And what that really means for the consumers out there is, from a retail channel, the money is coming directly from that retail lender.
Mm-hmm.
For the mortgage broker out there, they're essentially finding the investor that's going to provide the money for that loan.
Right.
And, you know, in each channel, I mean, both has pros and cons. I mean, it's really ultimately too, like, how comfortable are you with your loan originator?
Correct.
But, you know, I think one of the myths that is out there is that only a certain segment or origination channel has ability to offer these programs. And that's not true at all. So, you know, so from a retail standpoint, I would definitely say that, yes, a retail originator probably has more down payment assistance options out there throughout the country, because there are some state HFA, housing finance agencies, that don't want to do third-party originated business. But here in Texas, both TSHAC, Texas State Affordable Housing Corporation, and TDHCA, Texas Department of Housing and Community Affairs, are both open to third-party originated loans, which is great. So now it boils down to a manner for that consumer of, are they working with a loan officer that's been certified, taken the class to even be able to be educated and offer the product, or not?
Right.
And you know, you nailed it. You know, you led into a question of some people don't want to offer these programs, and you know, which is truly unfortunate. And there's some people on both channels that don't want to offer these programs. So, you know, I go back to, from the consumer standpoint, first of all, find an originator that is certified, educated on the product or programs, and whether they're offering it to you or not,
right?
Because that's going to be a better loan officer, I think, in the long run.
I agree.
Than somebody that's not. But yeah. So, long story short, from the retail channel, you know, it's staying in-house, so to speak, to do the underwriting and closing and funding of that loan. And on the broker channel, that mortgage broker is simply going to outsource the underwriting to, say, me. And I'm going to underwrite it and determine, okay, this loan works. Great, we're good to go. And then we do the closing and funding on the mortgage broker's behalf.
Gotcha. Okay. So that's great information regarding whether or not you, as a consumer, if you're out there, should you go with a mortgage banker or mortgage broker? Doesn't matter. You're in Texas. We all offer that type of program. If we participate or have the ability to offer that. Thank you. But it doesn't mean that just because we both offer it, that we both know what we're doing, the nuances, which program is the best for you, because there are plenty of them. When folks lead out with, oh, I've got bond program funds, or I've got this. Yeah, but which one? Which one? What rate? How much are you offering? And we'll get into that a little bit down the road on this episode. But I have a question or a statement, so to speak, misconception that goes around, which is, and I've heard it many times, is I can get you a better rate on the bond loan that they're offering you. And for me, my first thought is we're using the same bond. Right. There is no difference. We all have access to the rate sheet. Those rates are changed by them. We have no hand in that. We simply ask, how much funds do you want? Which category in the bucket or the matrix do you fall within? And that's the program. So for other lenders to say, well, I can do that lower, it doesn't jive. And I've heard it quite a bit.
I would think right out of the gate that it's actually irresponsible to just throw out to somebody that I can get you a lower rate with my bond program if without even talking to the consumer.
I agree.
Or know anything about it. Because and there's non-bond DPA and there's bond DPA, right? I mean there's two different ones. And the bond programs, what that means is it's a mortgage revenue bond, right? So the state gathered a bunch of money, packaged it up, and there's only a limited supply.
Right.
And traditionally, these funds are also typically for a certain median income level. So to put out a blanket statement that I could get you a lower rate with my program without knowing an income level, or if the consumer's even going to qualify, is just irresponsible. And it goes into setting up somebody for a bad home buying journey.
Absolutely. Especially with the additional requirements that one would not think are involved, such as, and you mentioned it, income requirements. Some even have purchase price requirements. Some have eligibility requirements on credit score. If you don't know the nuances to that, how can you even throw out a blanket statement like that? It doesn't jive, but not enough are being called out about it until the CFPB comes in and says, hey, you know this social media post that you put out last year? We got you. You know?
Yeah. I wasn't sure if it was Marcus Aurelius or my mother that just said there's a reason why you have two ears and one mouth.
That's so funny. 2 episodes in a row that has been said. Marcus asked me that 2 episodes ago, and I told him flat out. I said, so we can shut the fuck up and listen.
Yeah.
You know?
So those blanket statements they irritate me because then. You know, and the bad thing about social media too, I mean, I love it, but I also hate it because it goes down. But you've got an episode coming up on that, by the way. I can't wait to listen to.
Yes, sir.
But anyway, so just kind of coming back to the down payment assistance again, it's irresponsible to put blanket statements out there without knowing that borrower.
Right.
You know, and that goes back to, we have this available. It just may not be for everybody, but let's see if you qualify for it.
Absolutely. But the consumer has access to see it immediately.
Absolutely.
So if they want to go and log on to TDHCA or TSHAC or Seth, whatever, the rates are there public. So if someone is advising you that and you don't see it, then you need to probably
And
ask
I think
questions.
that's one thing that is missing that I continue to beat on this horse, and it's not dead yet, but the concept of the loan officer taking that high value trust interview up front so that they can educate the consumer, ask the right questions, get what it takes in order to advise them or provide any kind of options in way of, if you're going to go down payment assistance, let me bring up my screen, show you the rates, show you how they work, which you guys are going to see that here in just a bit when we talk about types of programs that are offered. But before we get into types of program, I want to talk about the why behind someone actually going with a bond program. I mean, there's many whys, and I want to kind of rap about that with you guys.
So I think for me, we have several clients that are looking at different, right? Because there's so many with the agency that you can go with. So whether you're getting free money that you don't have to pay back, and there are, of course, some caveats that you do. that may be an option if they qualify for income. There's also a new program with one of the agencies that has a lower interest rate. So that may help somebody qualify for more of a home at that point. So it's just going to depend on what are they looking for. And right now, I think especially for San Antonio or for Texas, right? Our income is lower. Our homes have gone up a little bit more. So there are a lot of people in cases that may need this assistant. Not everybody, because
Right.
it's not, this program's not for everyone. But if it is that it could help you become a homeowner, why not?
No, you hit it on the head. I mean, and there are additional, I'm sure John's going to get into that, but while you were talking about that, I actually threw up on the screen here what the average household income in San Antonio, and it's under 60,000. So, I mean, that is the demographic that we live around. That is the demographic that is in need of these type programs. While John's talking, I'm probably going to look up what the average month of savings that San Antonioites have. San Antonians? San Antonians.
And
the essays.
Yeah. And so,
I like that.
although I love these programs, right? Yeah. I think that there's also the easiest way I know how to explain it is it's not free. And I think that there's a misconception of that, right?
Sure.
So sometimes you are getting maybe a slightly higher interest rate than what.
We're going to go over that.
Is.
So don't get ahead of yourself. Absolutely. Yeah. We're pulling rate sheet up. We're going to go through it.
So I've got some whys. And it was funny when we were doing this and I saw the topic, I was like, ooh. And it just started jotting away because what was rattling off my head. First of all, I want one of your prove me wrong signs.
I love it. It's sitting right in that box right there.
It says, renting is better than owning.
Yep.
This is 2019 data. I mean, it came out a few months ago. That's come from the government, right? So
Normal.
It takes that long.
Yep.
So this is 2019 data from the Survey of Consumer Finance from the Federal Reserve Board. And the median net wealth in this country broken out by demographic, 188,000 for white families, 36,000 for Hispanic families, and 24,000 for black families.
Wow.
Median net wealth.
Wow.
Now, we could save a whole nother show on, getting into the political side of things. It's not what I want to do, but you think about all the issues that we have in this country. A lot of them boil down to one thing, the gap between the haves and the have-nots.
Yes, sir.
Regardless of political affiliation. And so when you drill down into the data on here, the key driver for these gaps is one thing, home equity, home ownership.
Absolutely.
And so that's why I'm such a huge proponent. Like, it gives me chills just thinking about that. I mean, because it really is there are a lot of things that happened in this country a long, long time ago that maybe led to, this head start, I suppose, for white families versus minorities.
That's what I'll call it.
But let's fix it going forward. We can't go back, but we could fix it going forward. And we could do this by educating people on the value of home ownership over time. Not get rich quick, not flip this house, but long-term generational wealth creation. If you take demographics out of the measures here, the gap between homeowners versus renters, are you ready for this one?
Yes.
396,000 versus 10,000.
Wow.
Almost 40x.
Wow. And the 10,000 that they're accounting for is probably their belief that they have equity in their vehicle.
I would agree with that.
Or their Jordan collection or something else.
I mean, it's median net wealth.
Correct.
Right? So there's financial and then non-financial assets. This is an interesting one too. So from the same data, NAREP, National Association of Hispanic Real Estate Professionals, recently kind of took their own dive into the data and they pulled this out, obviously geared towards the Hispanic demographic. But look at this. Home ownership was a 27 times net worth multiplier.
Wow.
For the Hispanic community.
Wow.
That's a big difference.
And then this is interesting too. So 70% of Hispanics' wealth is in non-financial assets such as home equity. So again, mom, dad live in a house, pay it off, pass away, they leave an asset to their heirs. That's how we fix up future generations versus wasting money on rent every month. So of those 70% of net wealth, non-financial assets, 77% of that was real estate.
Wow.
So it's crazy from that component. And so I just look at, okay, the why do we offer these down payment assistance programs? so that way we could get people into a house today.
Absolutely.
It's hard to save money in this environment.
It is.
In fact,
And I'll even go as far as to say that there are many that would say, I don't want to offer down payment assistance to someone if they've got enough money in the bank for their down payment. I disagree with that simply because what about the what if moments? I call them oh shit moments. When the stuff hits the fan, where's the money? I love to see 2 to 3 months of reserves and still go, hey, you probably need a down payment assistance, and here is why. You're going to end up getting a higher rate, et cetera, et cetera. But at least if day one you move into the home and God forbid something breaks that's not covered under warranty, you're not belly up on your mortgage, and this goes array when this is actually going to be building you wealth for the long term.
Yeah, or life happens.
Absolutely.
I mean, we saw a loan, and this is actually interesting because we do our company, we do a lot of down payment assistance loans. And you know, I need to actually pull this on the real data, but anecdotally, I could tell you that we're seeing more borrowers in the grand scheme of things that actually do have financial reserves, money left over. And I think that's just, again, the consumer sentiment out there is that, oh shit, what if life happens to me?
Right.
I mean, I worked so hard to save up this $16,000 that I'm going to get in this house, but then I'll have $1,000 left over.
Absolutely.
That doesn't leave a whole lot for room for
Absolutely.
emergency. So
No, you're exactly right.
That's a big one there. So kind of also going into the why.
Please.
Right? We talked about the demographic kind of, renter versus homeowner. But this is an interesting thing too, right? So NAR, I suppose, the National Association of Realtors tells us that the average age of a first-time home buyer is 36.
Mm-hmm.
Well,
and that used to be like 20 something.
A long time ago. I mean, the economy is forcing people to delay everything. People are having babies later. They're buying homes later, but we still have a demographic wave coming.
Absolutely.
And I don't hear a whole lot of people talking about the 4.7 million 33-year-olds that are out there, or the 4.5 34-year-olds that are out there.
Mm-hmm.
So if you look at the graphs and the charts, there's a big wave of people coming, which only tells me what? There's more demand coming.
Mm-hmm. Absolutely.
What's the number one killer of deals? Question.
Time.
Time is the number one killer of deals. So the longer that we put off our home buying purchase, our home buying journey, when this huge demographic wave is coming, then the greater the likelihood that I'm going to get into this multiple offer situation.
That's right.
Or home prices are only going to continue to rise. Or we're still overall putting people into homes faster than we are making them.
Right.
So, you know what? There does need to be that little inch of urgency. Now, with that too, right? I've told you I brought facts today.
Please. This is I'm soaking it in.
So this one too. So this is interesting. This goes to the education piece, and I blame Dave Ramsey. Love him, but I hate it when he talks about buying a house.
I know. Let's all get alt doc to get a loan.
Right. But it's not just him. It's also, I think, the talking heads on television. Whenever they say, "Oh, the average rate today is XYZ based on a 20% down." Or even just people that are asking their mom and dad and grandparents about getting a mortgage. They just think 20% down. So 1 out of 5 Americans believes that that you need 20% to put down.
Still to this day.
Still to this day.
And that's
this
with
is from June.
Social media, that's with the news, that's with blogs, et cetera, et cetera. And for the past, however, who knows how long, we as mortgage professionals have been singing the song of, technically, you don't need much down. You need earnest money. You need inspection money, et cetera. I'd love to see reserves, but you don't need anywhere near 20%.
Right.
Nowhere near.
And they don't understand that for every $1,000, it's only going to change your payment like $8 or $9. So 10 grand, you're saving $90. Like that's not going to break you. You probably spend that in a dinner in one night.
Unfortunately, but you are correct. Yes. Well, let's go through some bank statements.
Very, very true. And this was crazy too, right? 21%. I think believe that you need more than 20% to put down on a house. And so, we're still as an industry, originators, as real estate professionals, as anyone really, just educating consumers on what it takes to buy a house. I mean, I am still, I believe in the noble potential of America and humans in general.
That's right.
Every
Same
man
here.
wants his castle,
Faith in
every mother
humanity.
wants her nest. But we got to get them there. Survey. Renters, this should be of no surprise, are 3 times more likely to view saving for the down payment as the most difficult part of the home buying journey.
Wow.
And then to follow that right up, get this, and this is from Redfin, and it was 2 out of 5 millennials / Gen Zers. I mean, this is the millennial podcast.
So let me well, absolutely. And with that being said, and I heard this on PBD podcast, and I agreed with it wholeheartedly, and was like shouting at the TV, like, "Baby, look at this! See, he gets it." Millennials and Gen Z are very different. And by that, I mean, we're talking about millennials that are now hitting 40, guys. Put it in perspective for you. So lumping the millennials in certain situations is not always the right way to look at it, but I can see how the correlation, because we are one of the biggest yet to come generations that is going to be buying, period.
Right.
Mm-hmm.
And not all of them, because I will say, like, me growing up, I bought my house when I was 20,
Sure.
right? So back then, I spent $45,000 for a home. And the income, these new millennials and Gen Z are not making crazy amount of income where the house prices have gone. So for some of them, it is a little difficult. I'm not saying all of them.
That's a good point.
But I think that, not that things weren't hard for us at that point, but things were a little bit cheaper.
We're going to go off topic a little bit, but I love it. For me, I believe the only thing that has changed is perception. And what I mean by that, and perception and expectations. And what I mean by that is my first house, apples to apples, probably 20 years after you had purchased yours, was $130,000. We used USDA loan. I wasn't making bank. I mean, I think I was making $60,000 at the time, and Kristen was going through nursing school. So we were one income, $60,000 tops, right? We qualified for what was in our means. We understood the concept of I'm going to stop paying rent because I'm tired of throwing my money away, and I will sacrifice in living in, trust me, my apartment had a pool table in it, and I was looking over the pool. We had
also the dining room.
Yeah, we had the place. But understanding that I'm going to sacrifice that to start building some equity is something that I don't think that the next generation understands yet.
It hasn't been taught.
Good point. Right.
Because they're about lifestyle.
Correct.
Lifestyle of, because there's times that I've pulled credits and I've seen some car payments that are higher than a mortgage payment. And I'm like, whoa, you can definitely be.
Because I am also to kind of go against I'm seeing some Gen Zers that are making some good money. And I'm going, okay, well, what are you doing with it? Why are you not telling your friends what you're about to do, which is buying a home? Anywho, keep going, John. Sorry.
Well, no. I mean, that's a perfect little segue. It's not really a tangent. So get this. I mean, according to a Redfin survey, 2 out of 5 Gen Zers / millennials, so I guess that would be like under 40.
Correct. There you go.
Excuse me. Are currently working a side hustle to save money for down payment.
Yep.
So, and this goes back to that whole thing of, okay, they don't understand the whole process because, again, time kills all deals.
Yes, sir.
So if you have this arbitrary number that you're imagining in your head that, I have to have X amount of dollars saved up before I could buy my house. Well, if you have an apartment renewal, lease come for renewal during that time while you're building that, you might be stuck in that apartment for a whole nother year.
So true.
Versus, hey, we have these down payment assistance programs that we need to look at and explore and see if that's something that you could do today.
Absolutely. Yeah.
So, and this kind of goes along that point too. So we just hit in this country a record 8.56 million people with working multiple jobs.
Wow.
That's the highest it's ever been.
Wow.
So again,
so that's why they think the job employment is working really well.
Yeah.
I mean, no lie, it still is. I mean, that's not but a caveat to what John said. Just because you're doing it doesn't mean we can always count them both.
Right. Well, right. I mean, there's still, for qualifying cash.
Absolutely.
You still have to make sure, we could document it for qualifying. Right. But there's still 8.5 million people working 2 jobs. And I think it's also just a sign of, inflation sucks.
Absolutely.
Yeah.
Absolutely. It hurts us all.
It hurts everybody. And so, again, making people aware that you don't have to work 2 jobs for 2 years to get into a house for your family so your kids can have a backyard to play in.
Right.
But the inflation comes into supply and demand. So when we don't have homes to sell and we don't have stuff, we're going to start having higher interest rates, stuff of that nature. It's just
to bring it back down.
To bring it
We've
back
got
down.
to.
Right.
Yep.
I mean, we can't do anything about the corporate greed.
Right.
I mean, at the end of the day,
you could stop eating the Whataburger tacos.
I have stopped eating the Whataburger tacos the day that I went to that drive-thru, and it was literally the day after I had just gone through the drive-thru, and the price went up from one day to the other. And I asked them, number one, how much did it change? 2, why? And 3, do you get any of that? And they said no. And I said, well, what the hell am I doing here?
My daughter likes Chick-fil-A, so yeah, I need to get a second job.
I don't blame you. Yeah, I'm trying to turn this into a second job. But it's gosh, I'll just
nobody wants to pay you.
Yeah, I'll keep my daily.
So, but I think that those kind of come back to is the why, and it kind of boils down to home ownership in general being, really the best responsible home ownership being the best path for a family for long-term generational wealth creation.
I think that should be like a class in school, like
Absolutely.
how to handle their finances and so forth. So I will say I've got a 16-year-old, right? And in past, we've done great with money. We've done bad with money. We learn from it, right? Sure. And so I've got a 16-year-old and I told her, hey, you've got a job, but here's what we're doing. We're going to do 50-50. It's going to go into savings and you can't touch it. Mm-hmm. And she's done phenomenal on it. So I can only imagine what's going to happen when she becomes of age. And
so here's forth. My take on that, YG. She's winning because you taught her.
Right.
And yes. I don't agree with the concept of this should be taught in schools simply because they'd be learning it from somebody that actually may or may not know. I'm not saying that teachers do or don't. It's just, why leave it up to them to give their opinion on something that should come from within the household?
Right.
I think parents should be a little bit more transparent with their kids younger, just so that they understand what money is, finance is. And instead of shielding them, thinking that everything is always okay, then they grow up to 18 and now you're able to cuss in front of your parents and basically the truth comes out and you're like, well, shit, I'm working from behind.
Yeah.
I would have had a better understanding of this. And that I do have to kind of applaud my parents for doing, is educating my brother and myself young on what the financial situation was, how they got there, how to get out of it, how to make it better, and what we can do as men to move the needle forward ourselves for our families. Great point brought up.
No, I do agree with YG here. I mean, I think there should be some sense of basic home ec, how to create your own personal budget.
Sure.
I mean, the family needs to ultimately be the driver of that.
Mm-hmm.
But again, maybe we start with the young.
Yeah, absolutely.
I remember
just get the little foundation in there.
Yes.
Home ec for us, growing up, we were learning how to take care of babies and hold, like I was responsible for a kid and I was like, what? I can't even take care of a dog.
I had a baby for a whole 2 weeks.
I was like, my baby was cracked, was damaged. And so funny. I'm like, but if we would have learned finances and said we were learning how to be parents.
Good point. Good point.
We could have.
They teach you how to take care of the kid instead of having the kid itself. So, we've talked about the why. And I think one of the biggest whys, summing up what you guys discussed here, was there's a need for it. At the end of the day, there is a need that needs to be fulfilled, and we are able to provide that void filler, so to speak. San Antonio being among the top that actually need it based on the average income, household-wise, the credit scores, and the lack of savings that we have, unfortunately, because lack of discretional income, you know?
And they're even, I think it's TDHCA and TSHAC, they're also looking at like surrounding counties. And there are some counties that are getting a lot more money because of certain counties. I think Harris County is like one of them. And
I think they do it based on population, density, average incomes, things of that nature, which is why there are income limits to most, if not all, of these programs. Now, you've got companies like I Think Mortgage, where we created our own that we're funding through a third party, and it doesn't have income requirements. It doesn't have certain things, but it's going to be different in way of what they're offering. Will it be a higher rate? Possibly.
Absolutely.
But you're also asking for down payment assistance, even though you make over the average income that the other programs allow. $100,000 asking for down payment assistance. We're not going to say no, but you are going to get taxed for it.
Mm-hmm.
So, yeah. I'd like to now jump into kind of the basic requirements for down payment assistance, because we've talked about why it's needed, kind of what the difference between the two, and we'll get deeper into the differences when we go over the types of programs. I'll be able to pull it up on screen and folks can see those. But basic requirements, what does it take for somebody off the streets to qualify for most of these bond programs? What do we see out there, guys?
Well, I think this is a perfect little segue into my other section here
Let's go. I love it.
On myth busting.
Note, if you're ever on the show, be prepared like this, please.
So myth number one that I threw out here was that you have to be a first-time homebuyer. Myth or fact?
That's a myth. Matter of fact, YG and I were just talking about this before we started the show, where she was asking which one was it that requires the 3 years tax return. And I said, you know why they asked that? She said, yeah, absolutely. It's because they need to be first-time homebuyers. That's exactly right. So there are programs that do allow it and don't allow it. Go ahead, John.
So in that, and this goes back to, again, number one, working with a mortgage professional that knows all these different programs. And not all DPAs are created equal. I mean, that's the other thing there too, right? So if you have options, Texas Department of Housing and Community Affairs, they tend to have more bond issuance products. So they tend to gear towards specifically for first-time homebuyers.
Right.
But they also have, on the other side of the fence, TSHAC, Texas State Affordable Housing Corporation. They have zero requirement to whether you're a first-time homebuyer or not. But then they're rolling out a bond program next week, which I guess is technically next month.
Yeah.
Which
in the new year,
which will be a bond issuance that will be for first-time homebuyers only. But just because, if you've owned a home before in the last 3 years, that doesn't mean you can't get down payment assistance.
That's right.
And
or be considered a first-time homebuyer again.
And for our realtor friends out there, this is a good one, because I saw this scenario. This was up in Austin. Because what's missing from the marketplace right now?
Inventory,
move around, move up buyers. Absolutely. Or buyers buying another home, right? Why are they missing? Because they got into a 3% rate a couple years ago. So in this situation, borrowers did want to move, did want to buy another house. Of course, they didn't want to give up their 3% rate. All their cash, or their, which would go towards a down payment, was tied up in equity in that house.
Correct.
And so what we helped them do was structure the deal to where they converted their existing home into a rental property.
Perfect.
And used the down payment assistance to buy another house.
So what's wrong with that?
There's nothing wrong with that.
Nothing, in my opinion.
The funds are out there. They're available. You meet all the other boxes. Let's make it work.
That's right.
And I say that tidbit for our realtor friends out there, because I'm sure when they're doing their prospecting, they're talking to people like, man, I got a 3% rate. Really don't even want to think about buying another house. Well, guess what? You can.
That's right. That's called utilizing the system that was put in place, kind of like Donald Trump and tax returns. I had to.
He didn't make the rules.
Nope.
He's just following them, right?
That's right.
So I think that's myth number one. You don't ultimately have to be a first-time home buyer. Myth number two, you have to be poor. Do you have to be poor to get down payment assistance?
Not at all.
Okay.
Not at all. As a matter of fact, first you got to define what poor is, but once you do that, then you go, at the end of the day, you still have to qualify debt to income ratio wise.
You still have to be able to you still have to be able to qualify for the mortgage. Right. But where I'm going with that is, you don't have to be, these aren't programs for just low income people.
Correct.
And I think there's.
Yeah. Well, then Mark had mentioned earlier on your chat GPT that the average income was like 59, almost 60,000. And some of these are almost double that.
Correct.
In certain
80
areas.
some odd thousand. That's exactly right.
Depending if you have a greater household, if it's going to be different if you've got more than two and so forth. So there's a perfect opportunity that people who can make over 100,000 and they maybe have four in their family might be able to qualify for this.
Yeah. So I pulled this up and I just had the TSHAC stuff, right? So income limit for Bexar County, San Antonio, MSA. So that's, Bexar, Guadalupe, Comal, 120,000 per loan application.
Wow.
Not per household, per loan application, 120,000. And if the property happens to fall into a targeted area, that income limit jumps up to $135,000, meaning a borrower can make $135,000 a year and still get down payment assistance. And then our friends right up I-10, and this one was pretty interesting to me, at least. So, fun fact:
You talking about Kendall?
Kendall
Oh,
County
yeah.
has the highest income limit for down payment assistance with
And
TSHAC.
USDA.
And USD.
Yeah,
Mhm.
$150,000.
Wow.
Per household, or
That's right.
per loan application, I should
Correct.
say. And then if you've got properties that are even out there in the sticks, right? You're looking at $112,000 for the floor max income.
Correct.
So these aren't, down payment doesn't mean that you don't make any money,
Right.
but it's out there for literally everybody.
Right.
And that leads me to another myth, and that, again, these are only for small loans.
Right.
Not the case at all. We closed one a couple of weeks ago. It was $400,000 loan amount.
Mhm.
It was a new build, new construction.
Wow.
And that's how you got it done. Absolutely.
It was the only way the borrowers were going to be able to get into their house.
Mhm.
So they used down payment assistance, made it work. They could manage the payment, but like everyone else in the economy, it's hard to save today.
Right.
So, you don't have to worry about, these are only going to be, small loans. Not the case at all.
Right.
Myth: you have to have perfect credit.
No, you do not. I like that. Bringing that to the forefront. You're exactly correct.
So the qualifying guidelines for families on this, minimum 620 credit score, which, as y'all know, is by no means perfect credit. But we still follow FHA, VA,
Correct.
USDA, Fannie Mae, Freddie Mac conventional guidelines.
That's right.
So they don't have to be perfect, and 620 is far from that.
Right.
And then I'd even go as far as saying you technically don't even have to have a credit score to get down payment assistance.
It's true.
Now, it would be a manual underwrite, so there's going to be some other
Alternative credit
requirements, right, that you need to do, but you don't need to have a score per se. So,
And I think that's great that you mentioned that, because most do not know that at all.
Right.
The manual, I mean, we've done more manuals in the last 12 months than I've ever done in my career. Why? Because for some odd reason, the automated underwriting system didn't like their credit, didn't like their scenario, whatever it was. But we were wise enough and experienced enough to go, you know what? It meets the manual guide. They've got the reserves, the housing income, they've got residual down pack, they've got additional compensating factors, etc. Whereas new to the business, maybe that had not experienced that, veterans that never thought to go this route or are still scared of going manual underwrite, wouldn't even go down that road.
Right.
So, yeah.
And there's other programs or other agencies other than TDHCA and so forth, like the city of San Antonio. They have a program. There's no FICO score.
Yeah.
And sometimes they can get anywhere from 10 to 30, 35,000, depending on what their funds are available. And we've closed on some of those and helped so many people. We're just like, okay, you've getting now 30,000.
You've also got the, I don't know what it's called. Is it clout that the kids are calling it or something like that, where somebody doesn't want to go down payment assistance because they believe, they're going to think that I needed the money. But guys, they're normal loans, FHA conventional. Technically, the seller doesn't even have to know it's down payment assistance.
And it's NUNYA. There's a big old NUNYA for the third-party financing addendum.
It's exactly correct.
Nobody's business.
And then I think if they understand which program they're actually getting, because if it's a true grant, mind you don't have to pay this back.
Correct.
It's free. Now, I think there are some caveats, like if you sell your home, you turn it into a rental property within,
X amount of times.
Within X amount of times, it's going to do that. But you have this opportunity not to have to pay this back.
That's correct.
And then even on the ones that you do, you don't have to pay back until you sell your home. So if you stay in this bad boy for 30, 40 years, you don't have to pay it back until then.
I mean, historically, there's been many. I've been doing this 13 years and originating heavily the first 3/4 of it that have come back. We've been able to refinance it, pay that lien off with their equity, and they're still trucking down the road with a lower payment, equity sitting in their piggy bank, so to speak, for the future generation or to leverage on another property or whatever the case may be. But it opens the doors to being able to make bigger decisions for your life, utilizing your home as the driver to be Yeah. I mean, that's it.
That's why you're building equity.
It's the whole
So you
nine.
can use it.
Yeah.
Myth. These are only for single family properties.
Ooh, incorrect. Yeah.
No, that's perfect because my first home was a single family property. If my daughter's first home will be a fourplex.
Smart. Yeah, absolutely.
It's one of those things too, right? It's there's so much opportunity for folks out there. And you see it's, I don't like the term house hacking because I don't even think that just sounds weird, but no, I mean, if somebody wanted to buy a house, they could buy a fourplex, live in one unit and use the rental income from the other 3 units to help them qualify for that, or just for extra cash.
And to supplement. That's right.
Supplement it. And then on top of that too, they're getting down payment assistance to help get them in it.
Right.
That's right.
So absolutely. So that's it's for all properties.
And nowadays you find more of those properties than before in the past. Like we didn't find a whole lot of duplexes back in the past, but duplex, a fourplex
well,
now
I think the
common.
reason why is back in the past, they weren't letting them go. Once they built them, the owners would sell them as a portfolio to bigger investors, et cetera. But now the wave has begun of people like us buying them and reselling them, et cetera. So it's going to continue that way if us as loan officers continue to educate the consumer that that's even an option on the table.
Right.
Yeah. And in some cases, it may be the only affordable option for them to get into a house today.
Right. That's right.
Because essentially the rental income from the other units or units is helping to offset their payment.
That's exactly correct. So example, guys, if you've got a borrower in their situation, they, let's say, max qualify for $220,000 home, and that is single family. Well, if you move that over to a duplex, quadruplex, et cetera, and they're occupying that unit, now utilizing that rental income that comes from the rent schedule of the appraisal will allow them to maybe qualify for $250, sometimes $300. You don't know until you ask the right questions or give the right information. Be honest with your loan officer about what your threshold or tolerance is for going down that type of road. So, yeah, it's good stuff. It's good stuff.
Oh, absolutely.
You got some more myths?
I do.
I love it.
Myth. These things take too long to close.
That is a myth.
It depends what loan officer you're working with.
Yeah.
That's the right answer right there. No, I say that because I think there are some misperception. Again,
Absolutely.
not all DPAs are created equal, and the TSHAC TDHA product today is way different from how it was 20 years ago.
Right.
But we see on average these things are closing in 3 weeks.
Absolutely.
Standard 30-day real estate contract applies.
And I'm glad that you mentioned that closing time frame because I had one of my loan officers that reached out to me day before yesterday, and they were working a save a deal for a builder. Builder was saying, we're not going to allow you to go USDA because they take 45 days to close. I said, that is absolutely incorrect. I said, it is normal for us to request 45 days to set proper expectations, but that does not mean that it takes that long. If you've got the file set up correctly, now, once we're done underwriting it, we do have to send it to them to get our certificate and them signed off, et cetera. But who says that has to take 45 days?
Right.
I said, you reach back out to them, let them know that you've got the documents, you're ready to roll, and we can get it into underwriting pretty quickly. We just need to order that appraisal. Okay, let's go.
Right. It all boils down to the originator and the process and the work that was done up front. And do we have borrowers that are cooperating?
Absolutely.
Our record, the record I've seen come through on a down payment assistance loan was 11 calendar days.
So I believe that.
So you had a weekend in there.
That's right.
But it was a well-packaged file, had all the credit documents in it. I mean, there was nothing else to do.
That's right.
It fit the box and it was done well. So that goes back to working with a good loan originator that knows what they're doing and sets proper expectations up front.
Now that you mention that, super off topic, but I'd like to ask so that the others can kind of hear this. What do you think, John, is the biggest delay of loans closing and or having issues throughout the process?
That's a good question because I see it, again, everybody's different. But I would think the number one thing that I've seen
there's,
delay,
in my opinion, a couple parts to the mortgage process: the upfront, the middle, the closing, etc.
Right, and oh boy, that's a great segue into my last myth, actually, which is myth. I need to find the house before I apply for mortgage or down payment assistance. Yes or no?
Incorrect. Incorrect.
That is incorrect, right?
Absolutely.
So yes, this is crazy. 2/3 of renters think they need to find the house first before they go talk to a mortgage professional.
Wow.
Right.
But the cool part is it probably used to be bigger, and now who knows? They're getting educated. They understand that they need to get qualified, get their options before they go off looking for property.
Right. I would say for me, answering that question would be, we don't have all the information or the facts. And so I would tell anyone who's listening, a consumer, is that if you are not providing the documentation that your loan officer is asking for, then you're doing yourself a disservice, right?
Mm-hmm.
Because we have to look at everything.
Mm-hmm.
And sometimes you'll be surprised where you get, one pay stub and it's for January and it looks great. But hey, 2023, by the time I got it, that's not what your income was, or you made a lot more, or you did
Right.
this. So what's going on? And now we don't qualify for a down payment program that you were looking at,
or any loan,
right?
And that's what I was going to say. I mean, for the biggest delay is probably the hardest part on any loan. I mean, a down payment or regular loan today that I see in talking to our underwriters, and just what I see too, is income calculations.
Very good.
Mm-hmm.
And I say that because 10 years ago, I mean, everybody just had a salary or hourly
right.
wage. Now you've got 8 different categories of pay on your pay stub. They're all variable hours. Nobody's working just a flat 40-hour week. So
and also ever since COVID, we look at income a little differently too.
Right. And now I need to get a hold of your HR department to get a verification of employment so I could really know what your income is. Oh, but your employer uses this automated system that doesn't give us all the information or fill out all the boxes. And so I think income calculation is probably the biggest cause for stress and delay. Sure. Appraisals are easy today, for the most part.
Absolutely.
I mean, unless if it's a bad property, it's a bad property.
It is what it is. That's right.
But so that part, and so that's why I say, working with a mortgage professional up front, getting a real TBD loan approval. Mm-hmm. That means to be determined. And the sentence just, oh, hey, I looked at your credit report. Yep, you could go shopping for X amount. No, I'm talking, giving Mark and YG here your bank statements, your pay stubs, your W-2s, your tax returns. Correct. Let them fully underwrite the sucker before you go find the house.
Absolutely.
And there's, to me, there's not much worse, than somebody having their hopes up. They find the $400,000 house on Zillow. Hey, this is our dream home. And then they can only qualify for $300,000.
Correct.
Versus, hey, we got you fully approved. $300,000 is your max. Well, now they have proper expectations.
Right.
Now the journey is fun, and we're not let down because we can't get what we want.
Yeah.
And
I'm the type of loan officer, I'm the type of leader that believes it falls back on the loan officer.
Yeah.
In many cases, I'm not going to say all, but many cases, because we do have the ability to set those expectations, to set the ground rules for how this process is going to go. Yep. To demonstrate and illustrate how important it is that you give the correct answers to these things, and you do provide the documentation that reflects what we already spoke about. But it has to do with that upfront conversation, that interview, that high trust interview that loan officers have, and try to streamline or fast track or skip over when, if that first call took you an hour, I'm sure there was a reason behind it.
Right.
It's not a race to get off the phone and get to the next loan. It's let me gather as much as I possibly can to structure a loan, because the idea of TBD underwrite, do we do it? Absolutely, because everybody else does it as well. But do I think it's a waste of resources? Absolutely. It's basically taking the the underwriter away from what she's supposed to be doing to help validate a loan officer that should know these things after being experienced, or should have enough resources to go to before you have to go to the underwriter.
Right. I mean, and I could see that.
Mm-hmm.
It's just I think of it the eyes.
You're right.
It's with income being the trickiest
so
thing
nuanced,
out there.
Yep.
Or maybe not a full TBD underwrite.
Sure, no, we do it.
But at least having somebody, but at least having somebody that's going to make that underwriting authority.
Correct.
look at the income
Put your stamp
component
on it. Yeah.
and
Put your
say,
stamp on
okay,
it.
yeah, here's the income you can
Yeah.
use.
Because us as loan officers, we're going to push the boundaries regardless.
Yeah.
Absolutely. Well,
But-
as you should.
Yeah, I love when you brought up like the high trust, because I have to say over, the last 3 decades, I've changed stuff. So instead of like asking somebody, hey, where do you work at and how do you get paid? Oh, okay, just 40 hours. What do you get? Now I go a little bit more
Oh, yeah.
extensive. Okay,
You have to.
so tell me, have you taken any time off?
You have to.
Have
You're
you had
right.
any gap or anything of that nature? And I try to set the expectations up front saying, hey, feel free. Like, this is a safe place. You can tell me anything.
Yeah.
Because my job is to help you. But if I find something later, it's easier for me to deal with it now and come up with options
Absolutely.
as opposed to later. So I try to set that like in the beginning of the call, because I want you to feel comfortable to tell me everything. And most of them will then start opening.
That's right.
And, then you'll have like a real estate agent who will say, man, I took them 3 other lenders and they all declined them. Well, nobody really asked the questions.
Yeah, garbage in, garbage out.
That's correct. That's correct.
It's gosh, I mean, we just closed on a loan for a broker on Monday, and this goes back to the income thing, right? The co-borrower was a nurse practitioner, W-2, but she recently took a new gig that was paying her 1099. It's paying her more money, but guess what? You're now 1099.
You're self-employed.
I can't use any of that.
That's right. That's right.
So it made the loan a lot more challenging. Then we had to help them structure and pay off some debt to get their ratios to work.
Maybe you have to go non-QM, bank statement, etc.
We actually got it done with down payment assistance.
Okay, very
we
good.
were able to make it work, but it took a lot. And again, that goes back to, in that case, the borrower just didn't know that she shouldn't be switching jobs while in the home buying journey. But again, it was challenging, and the income component came into it, and that made what would have been a very easy loan into a little bit of a tougher deal.
Right.
That's right.
So I think the income piece is probably the biggest delay that I see out there, but it's the borrowers, they definitely play a hand in that.
Yeah.
So
And we have to be detectives as loan officers.
Yeah,
'cause
absolutely. And
I know,
And therapists and everything else.
Yeah, because I know when you're talking about like the automated systems for income, like for most people, we have to go and if your company uses an automated system, well, they only have like 4 blocks, right? You're either
Right.
going to have your base income, overtime, commission, and other. And some people see other and they think, yeah,
We
I
can
can
use
use
it.
this, right? And so when they use it, then they don't match it to anything, and they go look at their pay stub and they're like, hey, this was this
And that happens so often. And it's
FMLA
and
or
I
something
go,
of that
shame
nature.
on you, loan
Yeah.
officer, for overlooking that and not asking what it was and
Right.
have additional explanation for it, and then just totally counting it.
Right.
Because this customer is basing their next biggest decision on that.
we should literally do another podcast just on high trust loan application day.
Oh,
Yeah.
I love it. I love it. That's
Count
why
me
Loan
in
Bot
on
came
that
into
one.
play. I'm nerding out on stuff like that.
Awesome.
Absolutely. Because being in the position, in the seat of the bus that I am, I get to see from bird's eye view what happens with all of these situations with other loan officers, not just in our branch, but across the industry. And that's the one thing that has deteriorated, which is the high value trust conversations, that the loan officer needs to ask proper questions, listen, and find some way to retain so that you can advise based on what they provide,
Right.
So,
And then help make the borrower make informed decisions.
Absolutely.
Exactly.
Let's say that, okay, today T-Shack's rate is, here, we could use...
that's
we
going to
could-
be
we
our
could
next segue.
Yeah, so
go ahead.
no. We're segueing in.
Okay,
It was
so
a
we're
great little segue there.
segueing into what types of programs are out there. And I'm just using TDHCA, which stands for Texas Department of Housing and Community Affairs. They are a government agency that offers these programs to consumers. They have to go through certain lenders, whether it be broker or banker. But I wanted to show you on screen to be able to, I guess, let you know, have you aware on notice that this is public information. You
Yes.
guys can go and find these rates and determine what's offering what and for how much, etc. So that there are no smoke and mirrors that you see online and you start believing other things. Now, these rates were published as of today, so we're messing with real stuff. And notice there are multiple programs within all of these housing offerings. And
I love that one.
and we'll run through this real quick so that you guys don't think that DPA is only for government loans or only for FHA, etc. In this case scenario, you can see up here at the top that FHA, USDA, VA are all offered within these types of actual rate selections. Then over here, you can see that some are discontinued, and this changes on a daily, sometimes weekly basis. You've got loans that are affected by the average median income limits in the area. But for example, let's say that you wanted to offer a first-time home buyer a program that has a repayable option, and you go with repayable so that you can have a lower interest rate for the amount of funds that you're requesting. You'd look, let's say we're doing an FHA loan going by FHA guidelines, in addition to the guidelines that this institution or this agency puts on top of them, typically considered an overlay. But you can see here that the bond loan, meaning I've got to repay this, if I capture 3% of down payment assistance, so 3% of the actual loan amount, and that does include the upfront mortgage insurance, you'd be getting a rate of 6.87%. In my opinion, that's a damn good option this day and age, competing with normal loans, to be honest.
No discount points, guys.
Correct. Then you've got different programs such as this one where it is a first lien. So you're basically selling this loan. Go ahead.
I was going to say, what does that say? No DPA.
It's so strange. It snuck up on them. So this here is not down payment assistance, but they become the investor for this loan at a lower rate. In my opinion, this is allotted to the consumers that have saved enough for down payment, that are able to take advantage of this low rate, meet the income requirements, etc. And this is basically the housing agency hedging against all of this other stuff, in my opinion.
They're subsidizing the rate.
There you go.
And what I would say about this, and we use this quite a bit, believe it or not. I mean, every loan is different. Every family is different. We've established that. But sometimes $20 a month difference in calculating income can make the difference between that family buying a house or not.
That's right.
So perhaps a 6.875 rate puts them over the threshold for being able to qualify. But if they could get a subsidized rate at 5.75, maybe that's just enough to put them under the threshold.
Absolutely.
Which means they get the loan.
Absolutely. Now, John, with that 5.75, do you get down payment assistance?
That no DPA there.
No dinero.
Right here, I want to
No
make sure.
enganche.
With the big circle.
Matter of fact, I think I can do that.
I think Mark is trying to
Right
prove
there.
a point, guys.
No point. Just educating.
Look, this goes back to originators. If you're going to sell something, you better know what you're selling.
Right.
That's exactly correct. So I think we've gotten a lot in. YG, you were like, how the heck are we going to fill an hour? We're past that.
No.
We are past that. Just like that.
Here, just scroll down just a minute too, right? So up there, you notice it says 30-year deferred repayable second
Correct.
lien. I mean, that means that however much assistance, that 3%, right? So we'll just say $300,000 loan amount. That's 3% of that. That's $9,000. That means the borrower will have to pay that $9,000 back. However, they don't have to pay it back today. They don't have to pay it back tomorrow, just whenever that loan pays off.
That's
meaning
right.
they could wait 30 years and pay off the mortgage, or they could sell it in 5 years and do it that way. Or they could refinance it
That's right.
and roll it into their new loan up to maximum loan to values. And then below that, you see the 3-year forgivable second lien, which means that however much assistance the borrower gets, right? So you see there's a 4% available today at 8% rate. That would mean that $300,000 loan amount, the borrower is going to get 4% assistance. That's $12,000. That means that borrower does not have to pay it back as long as they're in that house for 3 years.
That's right.
And then poof, it disappears. And obviously, you see the downside would be they're going to pay a little bit more in interest rate versus the other one. But
Correct.
You know what? What gets you in the house today?
That's
and
right.
what are you comfortable with?
But I can't charge a lower interest rate than John, guys, because we got the same rate shade.
Not unless you want less
That's right.
funds.
The state sets these. T-Shack, same thing. I mean, they set those rates daily. They change daily.
Yeah.
And
Now, I will say too, looking at this rate sheet, we have a couple on the top that are just not available, right? So I will say every day we've got to look at these because sometimes they do replenish funds. Sometimes there's more. And then if you're looking at a program like this, you have to keep in mind that it could go away. We can only lock into this once you have a contract.
That's right.
So I had one client that was looking at the no down payment and was stuck on that interest rate. And when it was gone,
It was gone.
it was gone.
That's right.
Right.
And, you've got to make sure that it's available. And as loan officers, if you get one, you need to register that loan immediately.
Absolutely.
Immediately.
Absolutely.
So just to put this in perspective too, and this kind of goes along the same lines, is these do change every day. But I also tie this in with getting pre-approved first, right? Knowing what you are, because at least if you're pre-approved, then you're working with a good realtor partner.
Right.
Then guess what? As a home buyer, you've got some strength when you're negotiating, because you don't have to max out and take the maximum
Not at all.
DPA.
Not at all.
So T-Shack today, 5% assistance they have available at 8.125 for the note rate.
Gotcha.
But maybe if I can get other seller concessions, maybe I don't need 5%. So they have a 3% available that's forgivable for 3 years with the 7.375. So again, this just comes back to door number 1, door number 2, door number 3.
Yeah.
Work with somebody that can provide you options, that knows the programs.
I mean, and in some cases, you've got borrowers that have their own their own down payment with maybe a lower credit score that are paying higher rates without the down payment assistance.
Right.
So I think there was plenty for realtors, for lenders, for consumers to pique the interest of actually wanting to know more about this, to know that it is not a one-size-fit-all or a one-way or the highway type concept. I think that we were able to articulate the offering of lenders and their ability to do so with the participation, and that it's not strictly for one or the other.
Right.
And it is not something that should be overlooked, especially the time in the market that it is, the location and our demographics that we have here in San Antonio, and the demand for what it is, the American dream. How do we accomplish that?
Yeah.
Here's a solution to that in many cases,
And one thing we didn't talk about, and I would love to hear the way you describe it, is the mortgage credit certificate. And I know that there's like other programs that combine it with it. So I always kind of say it's more of like a government coupon that you get for your deduction and get credits. I would love to kind of hear how you explain that.
Yeah. So the mortgage credit certificate, if and when it's available,
Right.
every borrower should
Absolutely
see if they qualify for it. And what it is a dollar for dollar tax credit equal to a certain percentage of the mortgage interest they pay back.
Yep.
And T-Shack was the last one that really had the MCC. They ran out because, they just ran out of funds for it. But it was great to be able to show what it did for consumers, because it was a 20% of the mortgage interest a borrower pays, we're going to get back. And so what does that mean? So if they paid $20,000 in mortgage interest in a year, they were going to get a $4,000 tax credit, not a refund.
No.
But an actual credit
on their tax return, which then lowers their total tax amount and could move you to a different bracket.
It takes out your removes your liability. But then, more importantly, from the qualifying standpoint, we would get to use that, say, $4,000 as income to help you qualify for the mortgage.
That's right. It used to be $166. Now it's gone up to a little bit more.
It's almost 20%.
No max.
Okay.
No
max.
max.
There was no maximum amount. So, and I like to put it in terms of what does it do to the effective interest rate?
That's right.
For a borrower. So, if you were looking at let's just say, let's say the note rate was 8%, and I'm just using that as a random number. So if I were to multiply 8% note rate times 80%, that gives me what? 6.6, right? So my effective interest rate as a consumer, then, I'm not really paying 8%, I'm paying 6.6.
That's right.
Because I'm taking 20% off the top with that government tax credit, that government coupon.
The government coupon.
That's right.
Yes. The MCC is unavailable today.
Right.
It will be back. According to T-Shack, they're looking at mid-April.
Okay.
So it will be back out there, and it'll be in conjunction with DPA, which is
get
awesome.
ready for the posts announcing it.
Yes. Oh, yeah.
Oh man. Okay, that was a fantastic discussion regarding all the down payment assistance nuance. Go ahead, John.
No, that was great, and I just thank you for having me on here.
Of course, man.
I love sharing my hot sports takes, but I come back to just the why, and you look at again that wealth gap by demographic: 188,000 for white families, 36 for Hispanics, 24,000 for Black families. Let's bridge the gap.
Absolutely.
And we can do that with responsible home ownership, taking advantage of these programs that are out there and available, and working together to have an honest discussion with consumers about what their expectations need to be.
Absolutely.
And let's get you in a house to set you off for the betterment of your future generations.
Absolutely.
And I'm not running for Congress.
Too much dirt. Too much dirt.
I'd bet
Just
on you.
kidding.
You'd have my vote.
Mine too. Well, guys listening, first, thank you, YG, for joining on this. John, thank you again for joining on this. Guys out there, gals out there, I think I'm totally with them too regarding the bridging the gap of the wealth. I mean, there's only one real way to do it that has stood the testament of time, which is home ownership. I think education is a huge part of this. If you are not knowing where to look, if you're not getting the right information, and maybe have questions, jump online, but be sure that you are looking in the right places. Again, drop in reviewmymortgage.com. Go there. Educate yourself on the different bond and grant programs that you may be able to qualify for as a consumer. And then the second piece to this, which in my opinion may actually be bigger than the first piece, which is taking action. If you don't take action, you can stare at a jar that is full of potential all day long, but until you uncap the jar, the potential stays in the bottle. And it goes nowhere, guys. So again, I want to thank you guys again one more time. Really good information, really great insight to the topic at hand, and hopefully that gave you a little bit of 411 on DPAs. So until the next one, we'll catch you later.
Adios.